G'day, Adrian here. I'm here today with Helen Smith, a mortgage broker. Welcome, Helen.
Thank you. Well,
it's good to have you here. Look, we're doing obviously some educational things now for our buyers and sellers out there that are looking to get into the property market, and particularly when it comes to finance. So in my space, I mean, I'm obviously a real estate agent at Harcourts in Wollongong, and I'm talking with buyers and sellers every day. The finance side of things is something that becomes really tricky, and at times it can get complicated.
Yeah.
It doesn't need to be.
Yeah.
So let's shed some light on a couple of grey areas. Firstly, let's talk about maybe the difference between, say, a broker
Yes.
and a bank, or you know, a non-bank
Yep.
for that matter. What's the difference?
A mortgage broker has a range of lenders under what they call their panel. And a panel can consist of 30, 40 lenders, down to 10 lenders if you're a smaller firm and you aggregate your loans through a company.
Right.
That sounds a bit complicated, and I don't mean to do that, but what it is each of us are linked to a company, and they're called aggregators, and therefore we have a choice of lenders under that panel. Whereas if you go directly to one bank, you have the choice of that one bank's product only.
Right.
And if you wanted to get a comparison, you'd have to walk the street and go door knocking at each of the different lenders.
Mm-hmm.
Whereas if you use a mortgage broker with, say, 30 lenders, you've got 30 choices on your panel.
Got it. So from your perspective, I guess, if someone was to go to you and say, look, Helen, I need a loan, then you would have the option of going to many different lenders,
Yeah.
and you could have, obviously, there are many different, what you call products.
Exactly right.
So not only are you going to different lenders, as in financial institutions, but they also have a range of products as well. Is that right?
That's correct.
Okay, so if it was a residential home, then it could be one style of product, or if it's a business loan, it could be another.
Exactly right.
So
commercial, another.
Correct.
Personal loans, another. You get a whole different range of lending and lending criteria and lending products, as you said.
Yeah. Fantastic.
You know, yeah.
All right, let's talk about first homeowners. So
Yes.
first home buyers, obviously new into the market, they've got to go out and research the marketplace. They want to have a look for a property they want to buy. So what are the first things that they should do? Because I see a lot of buyers come into open homes and they say, we love it, we want to buy it, but guess what? They don't even know how much they can borrow. So let's start from the beginning. What should they do before they even start looking?
Okay, before they start looking, hopefully they've been saving. Nowadays, banks want borrowers to put money in themselves. Gone are the days of borrowing 100% of the purchase price.
Mm-hmm.
So the very first thing is hopefully 6 months previously they've decided to start to save. Build up a nice little deposit, and then you're feeling a bit more confident because you think, oh well, I can prove that I can put that aside of that money. Once they've found that they've got a deposit, and we can work out how much that has to be once you've sort of worked out their borrowing capacity, you'd ring a broker and you'd say, look, can I come round and work out how much I can borrow? Bring a couple of pay slips with you and some idea of your deposit amount. Mm-hmm. The mortgage broker will sit down with you and say, we'll work out, is it a base wage that you want to work it on, or do you want to use some overtime? Because all of those rules come into play and allow you to borrow different amounts.
Right.
You know, so if you know that you only ever get a flat wage and occasionally you'll get a bonus, you might say, look, I want to work out my borrowing capacity, not using that bonus. Mm-hmm. You might also have in your idea that you want a dream home on Sydney Harbour, where you'd have to use every bit of bonus that you'd ever earned, I think. But that's it. So you work out your borrowing capacity by sitting down with a mortgage broker, but you've got to be prepared when you go to the mortgage broker. You've got to have your pay slips ready, your group certificate, your groups, they're called tax assessment notices and group certificates, payment summaries, all of those things. Mm-hmm. You'd know if you've got any debts, so you'd say, all right, well, I know I've got a car loan, and you'd know what your repayment was on that too.
Sure.
So take those details to the broker, mm-hmm. and they can sit down with you and work out exactly how much you can borrow.
Fantastic.
Once you've done that, the mortgage broker might decide to say, look, how about we get what's called a pre-approval.
Got it.
And you probably know that a pre-approval makes you feel more confident, because then you know that that particular person that you're speaking with has gone to the trouble of getting all those things together.
Fantastic. So if a first homeowner comes along, as long as they've got all the information at the beginning, meaning you know how much they're earning,
yes.
but also you need to know how much they're spending,
how much they're paying out on
how much is outgoing, I guess, and maybe a history of how much they're saving.
Yes.
What if they're renting? What if there's a first homeowner, they've rented for several years and they're paying a good amount of rent on a regular basis, and it's been a couple of years now, but they now want to go and enter the property market?
Right.
How does the banks look at a tenant that's been renting and paying their rent on time for a couple of years?
Okay. There are 3 lenders that come to mind immediately that say, if you've been paying rent, we will class that as toward your genuine savings, meaning that the bank says, well, you've been paying rent, you've been proving you've been doing it for 2 years,
yep.
So instead of saving, we'll use the rent. But there's only 3 lenders or so.
Got it.
Most of the lenders will still want you to save money, but these particular lenders that come to mind will say, no, rent is classed as genuine savings. But it still doesn't get over the fact that they will still only lend you 95% of the purchase price. So no matter whether you have savings or whether you can get a gift from Auntie Mary or Cousin Joan or whatever, you're still going to have more money, not just the rent. You've got to have savings or some money to put towards the purchase.
Got it. Okay. This is really good info. I mean, everyone needs to know a lot of these things. Now, let's maybe move on to a homeowner who's looking to sell the property that they're living in at the moment, and they want to go and buy an existing property, all right, or another property. So the scenario would be, I guess in my field, a lot of the cases, I own my own home. I don't have savings as such because I'm looking after kids, I'm putting everything into the mortgage, all those sorts of things. But I bought the property for $250,000 8 years ago. It's now worth $400,000. So I have what's called equity within that property. How do I now go and buy another home and juggle the two?
Perfect. That is a great scenario. And I was so interested to see what you were going to say, what the value of your house was.
Yeah.
If you'd bought a home and paid $254,000 for it 2 years ago, and it was still only valued at $280,000, that word equity that you used, that wouldn't be enough equity to do anything with.
Right.
But when you've got a big equity amount, like you said, $250,000 to $400,000 value now, that allows the bank to say, we don't need any savings from this particular applicant. We've got the equity in that existing property. So the bank will then allow you to borrow 110% of the purchase price if you need that much.
Got it.
You can cover your purchase price, you can cover your solicitor's costs, you can cover your stamp duty, all because you've got equity in your existing property.
Fantastic. Can you tell me, it's interesting you just mentioned things about stamp duty and solicitor's fees and all those sorts of things, right? So if I'm borrowing money to buy a property, let's say we'll use $400,000 again as a purchase price, is it just $400,000 that I'm borrowing? What else is included in the borrowings? Because there's a little bit more attached to it, isn't there?
Yes.
So I'm not only looking at the purchase price of the home, what other things do I need to consider that are going to add on to my expenses and costs at the end of the day?
Well, let's leave first home buyers out of it. First home buyers, there is grants if you buy brand new houses. So let's leave that out of it. Anybody else who's buying an existing home have to pay roughly 5% of the purchase price in a whole pile of fees. They range from government fees for stamp duty, they range from solicitors' fees for doing the conveyancing, they consist of other stamp duty transfer fees.
Right.
There's another fee called lender's mortgage insurance.
Yeah.
There's another fee. Oh, the fees can keep on going. Bank application fees. There's another fee called a rate lock fee.
Wow.
So you've got to allow at least 5%
Yep.
to cover the basic fees.
Mm-hmm.
But that mortgage insurance could take that figure way over. And it depends again on how much saving you've got or how much equity you've got, decides how much that mortgage insurance fee is.
Got it. It's interesting you say when you're adding all these fees, how much of a difference does it make to my lifestyle, to my repayments or the life of the loan? If I'm thinking about saying, well, look, I know that the purchase price is $400,000, then I've got the stamp duty, as you said, then I've got mortgage lender's insurance on top of that. So it may be that I've got roughly $420,000 would be my overall loan. So how does that affect me in terms of my loan repayments, or does it lengthen the loan or the life of the loan? How does it work there?
Well, if you did a comparison of $400,000 loan compared to a $420,000 loan, it would make a difference in your repayment.
Yep.
Most loans now are done over a 30-year term, and that's the average now for all loans. So you wouldn't extend the term because you've probably taken it to the maximum anyway. So really you have to be prepared to pay more repayments, and the higher the loan to value ratio is a magic word, and it means LVR, and it means how much risk has the bank got. If anyone borrows more than 80% of the purchase price, this mortgage insurance fee jumps in.
Yep.
If you don't borrow more than 80%, you don't have that fee.
Got
So
it.
therefore, you really only just have to allow 5% to cover costs. But if you wanted to put the mortgage insurance, it definitely increases your repayment and therefore more money out of your pocket.
Right.
So the more money you put in, the cheaper your repayments.
Okay, so if you're borrowing, when you mentioned that word LVR, loan to value ratio, so if you're borrowing more than 80% of the purchase price of the property that you're going to buy, then the lender's mortgage insurance, which is obviously the guarantee that the bank has is securing that against that loan, that kicks in. But if you're under that, so for that example that we used about a buyer that had an equity in their home, so let's say they had more than 20% deposit to put down, it wouldn't come into play within that loan.
Exactly right.
Got it.
Either the equity or the cash.
Got it. Right, yeah. So,
More questions.
more questions. It keeps going. I mean, obviously we're trying to appeal to a large range of buyers and situations. So I guess the next thing that I really wanted to discuss today is obviously because when I am dealing with buyers and sellers, they're often in situations where they really don't know perhaps how much they can borrow. But I'm really interested because I remember you telling me once that there was a difference between one lender and another lender. So not all lenders are equal, right?
Exactly right.
Okay, I mean not all banks are equal, and so you've got the same buyer or the same person that's borrowing money, but between one bank and another bank or another lending institution was so much difference, in terms of price.
Yeah.
So give us an example of, tell me the example again of who it was or not.
I ran it through, speaking with you about that. I ran a scenario through a computer, and the computer I put in, there were two applicants, a man and a woman. The husband was on $50,000 and the woman was on $30,000. She has taken part-time work and they have two children. They had one credit card with a limit of $10,000.
Yeah.
And I think from memory, the different lenders, it was something like $100,000 difference between one lender and another lender.
Right.
Now, if you knew that you wanted to buy the house on the Sydney Harbour, you wouldn't go to the lender that allowed you to borrow here, but you're not going to know that. You wouldn't know that until you went and physically walked around from door to door to door to door to all the different lenders to see. So that's that's another reason why you'd want to see, all right, am I going to try and borrow the most I can? Well, then you want to do it the easiest way, which is putting all that income through in your computer, pressing that calculate button and just seeing the difference of all the different lenders of what they lend you. And the other thing is too, Adrian, is that between the products, between one particular lender, you might go in and say, look, I want a variable loan. Nowadays, the banks usually let you borrow more money on a fixed rate loan than they do on a variable loan.
Got it, okay.
So if you took a decision and said, all right, I want to fix my loan, and you decided to have a 3-year fixed rate, that means the rates wouldn't change for the 3 years and you're locked in on that, the banks would let you borrow the maximum on that rate compared to a variable loan.
Wow, okay. All right. Can you tell me, what's your crystal ball say when it comes to mortgage rates? Because obviously in the market, I mean, in the last couple of years, we've seen rates go up a lot and no one knows why. And, you know, to every layman out there, you're sort of thinking, well, I don't understand. It doesn't seem to be too good out there, but the rates are going up. And then in the last probably 6 to 12 months, rates seem to be going down. You're hearing a lot of doom and gloom out there, but then locally we're kind of seeing a fairly sort of robust market. So what's your crystal ball say? Where are the rates going to go in the next, say, I don't know, 3 to 5 years? I know it's a long way away. What's your call?
If you wanted to look at what the banks are doing, the average lender has an interest rate on a 5-year fixed, as we talked today, of about 5.6 to 5.8 is the interest rate for a 5-year fixed.
Right.
Their 1-year fixeds are 4.8s.
Wow.
Now, so if you want to look at that, what does the bank think they'll do? To me, what they're saying is there is going to be a rise over the next 5 years.
Yep.
They don't offer 5.8 interest rates if they're thinking the interest rates are going to be 15%.
Correct.
Right? They'll only offer 5.8% if they think the interest rates might get as high as 5.8.
Yep.
So they're thinking they will rise slowly but not much. Everybody seems to think that the economy is just going to hang in there, to sit in the middle of the, ways, with slight rises. And that's about as far as anyone's prepared to say, including me, because I don't know.
Yeah,
it's too hard. It's too hard. So, I mean, when you're talking to a lender nowadays, I usually suggest people split their loan.
Right.
And by having a split loan, you have some variable, some fixed. So if the interest rates do go down further, at least you're going to go down further. And your fixed rate, if they do go up, that fixed will
stay the same.
Yeah, that's it.
Well, that's actually really stimulated a great question. So, fixed or variable? I mean, it's in the last, say, 12 months, it may not be the best scenario in my eyes, I guess, to maybe fix a loan for any long period of time because they seem to be sort of chipping away at it. But what do you think? Fixed or variable? Split? How would you... Is it one size fits all? How does it work with different customers?
Every customer is so different, and it's amazing whenever you speak with somebody. Everybody wants the best interest rate, so let's not be silly about that. If we want the best interest rate, what's the best interest rate for you at this time? Are you expecting a baby? Do you want to have security and know exactly where you are? Have you got a big expense coming up, like a world trip that you know that you're going to have a limited income? Well, then you'd probably go fixed. If you know that you're expecting a large amount of money from a legacy or you've got a whole heap of overtime coming up, you'd probably want more ability to pay lots more off your loan. If you have too much fixed, most lenders limit how much extra you pay off your fixed rate loan. So then you'd say, well, fixed mightn't be the best for me. Let's go variable.
Got it.
That's why I like the split loan system. At least then your variable, you'd make it large enough to take all that extra money that you're hoping to earn or going to get as a legacy. But then you've got your fixed to give you your stability. You know, everybody's so different, and every person, whoever does a loan, is so different.
Sure. So obviously, depending on the applicant, their lifestyle, what they plan to do, what they're going to do in the future,
all that's taken
could
into
determine
consideration.
which side of the coin they're going to go to, or whether, like I said, it might be split or one portion fixed and one portion variable and all those sorts of things.
That's exactly right. And that leads me to another very important place. Part of the mortgage brokering rule and licensing is that we must look at each person's individual situation. How much do you spend per month on going out for dinner? How much are your lifestyle living? How much do you pay out for car loan repayments? And all of that stuff is factored in as well. Once we make a recommendation, that recommendation has got to be as deemed suitable for your requirements. Like if you told me you only wanted to keep your house for 2 years, this new home you're purchasing, I wouldn't lock you into a 3-year fixed rate. Huge costs if that was the case and you wanted to sell it at the end of 2 years. So we've got to be really careful that we ask a lot of questions about where do you want to go in the future, what do you want to do in the future. So all of those type of